What's up, guys? Welcome into part 2 of the market breakdown. In this part, we're gonna take a quick look at GJ and we're gonna dive into the metal market and more precisely gold. And I'm gonna run you through what I potentially see on gold, give you bits of tips and tricks on how I trade gold and how you can try to implement some of these tips and tricks into your trading and your strategy to just try to be a bit more efficient when it comes to trade. So a lot of the stuff I will cover, they cover the basic of the strategy on how to find trade and picking trade. But what I'll be doing maybe in another video, let me know in the comment if that's something that you would want to see, is the trade management side. So when it comes to targeting, how much movement do you allow against you before taking a loss, and this kind of stuff. So everything that is trade management related. Maybe I'll do some more video later on. And for now, we're just gonna focus on how to pick a trade and what is a possible trade when it comes to gold. So enjoy. So, what are the next possible move, where we could go, and what could pique my interest? Note that I had an interest in the 2008 level, probably seen that on social media. This is something I mentioned last Friday on our training floor. There is a small, very weak level there. If you look at the 2008, something that's been working less than half of the time here. So this is a very weak key level. So I wouldn't use 2008 as a reference for a strong key level. That's something there. Whether you consider it a strong or weak level, it's up to you. The fact I've used 2008 as a price to go short on Friday is something I've discussed already before when it comes to aligning your market. I touched upon this on the GGA video before. And I strongly invite you to check the video on Techonomental here. Alignment is probably the strongest confluence I have on my current trading plan. It's helping me identify driving force in the market that are beyond technical. And another example here was the fact that on 2008, so if you look at 2008, on Friday, you could see an initial reaction from the level, dropping over 60 pips, retesting it an hour later to drop even further down, to come around the level again, and then dive way further onto the weekend and giving us the pullback we've seen this morning. So on this level, on the initial reaction, why 2008 was a possible short level. Well, whether you consider it as a key level, it's one confluence. The other one is that we made this intra-level reference on the Friday afternoon, and then came back to it an hour later. But what happened in this hour, and this is where this can help you identify sometimes where areas where you can go again on the trade, or you can go on the trade if you missed the first time. This alignment thing can help you tremendously to identify areas that are still worthy going for or not worthy going for. In this particular case there, we had S&P, so S&P there, on the, move it here. We had the S&P on the level, and if you go back to the S&P, we had a couple levels here. We had this one. And we had the next one here. So simple key level rejection. So what happened on the previous level here? We had a couple of reaction around there before. Let me go back on chart S&P. Where you moved in there. As I was saying, we've had some nice rejection here and reaction. This is a no-go when it comes to having a key level like this that is so close to a reaction that already occurred, less than 20 pips away. So I had no particular interest on this level, especially when nothing was aligning on the market. However, on this breach of the level, it reinforced the odds of success for the next one. It's just simple statistics. Whenever you got two significant key level in a row, if one breach, the other one get far more chances of working, for the simple reason that whoever is pushing the price toward the next one is not gonna be feeling that he's going to be smashing further level. And as such, when you're in control of the price movement, the momentum, if I'm in the momentum to the downside and I'm making money as we go down, if I am smashing one level and we're coming near the next one, I think the chances of this being smashed are lower. And as such, it's not that I'm going to short and reverse, is if I'm short, I'm going to take some of my profit away, if not all my profit away. And this is what is causing the switch in balance between seller and buyer. And this is what creates the reversal momentum. And I'm a reversal momentum trader. So my job is to find where somebody is making a lot of money and where is likely to take its money out. Because for me, it's easier to spot somebody making money on the market rather than somebody that is about to make money on the market. And I found it easier. It is sometimes a bit riskier because when you go against momentum, sometimes it's hard to get it right. But with few things like alignment, strong tech, and a proper trading plan, I think it's quite safe to do so. And I prefer to do it this way. I found the trade more obvious to me in a way. So that is my trading style. So the 50 cal strategy is all based on momentum reversal. It also is using momentum, and as such you can ride momentum. But the whole strategy I've developed is based on the fact that I identify area where the market is going to take some profit and as such create some reversal opportunities where I want to be in and out. So if you look at this, I digress a lot, but coming back to this, when we bridged this level and we went to the next one, its odds of success was greater and had my interest. The fact that we were late on a Friday also, which is often a profit-taking timing, piqued my interest. But the fact that we had gold topping 2008 and not making further high was a great alignment. Indeed, when you got alignment, you have to think of alignment of what's moving the market. What's moving the market, the driving force that moves the market doesn't move just one asset, one currency, one commodity. It is across the whole market. This is why this is the driving force. So if the driving force is matching level on S&P, so the force that is going to move actually S&P is very similar to the one that is going to be moving gold. So if gold is not making a new high and S&P is reaching a level where it's very likely to reverse for a buy potential, then I'm likely having the driving force behind all of it that is getting exhausted, and as such increasing the potential of reversal. And this is why I went for the reversal on S&P. And this is why I've used some of the runner I had long from these two positions there to go for the potential short, which has pretty much no tech. So not every trade is going to be tech focused for me when I enter the market. I look, with years of experience, I have learned to look beyond just the tech rhythm and big alignment. I strongly suggest to get very knowledgeable about this with the videos I've released, because this is game changer when it comes to picking the right tech fundamental trade, but even just picking a trade. So based on that, what is now likely possible on the market? So because we are coming near all-time high, I'll show you all-time high here. If you look at the weekly, there, your all-time high is around there. So we've pretty much matched the all-time high when we retested it. And that will be the third time now. So this all-time high, after this, we've got no reference. So what does it tell me? It tells me that before we get there, you best pay attention to every possible technical reason you have for a pullback. And as such, I'll look at the recent price action, and I'll look at all the sizable rejection we've got on the market. So we've got some sizable rejection there. Here. We've got one there, not the major one, but that's the next one. And then if I put this one down, you'll see that this is where we're coming from, and this is where we are there. Okay, so based on this, what are the next possible level of interest? They are the following one. Now what you'll notice, so it's very quick exercise and very easy, get used to it. Sizable rejection will create very tech-driven profit taking if there is some occurring on this area. Now on this area, what you can notice, and that's something you need to pay attention to when you come to trade gold, because gold is more than just tech and fundamental. It is very psychological. And there is a lot of psychology to understand around trading gold. And I've made another video, you can check the link below there. It is how psychological level works on gold. And on this video, I covered the big psychological level, 1800, 1900, 2000. How does it work, how you can use them, how you can trade them. So check the video out. It still works to this day, and if you actually check the video and you've used it in the past few weeks, you would have made some really good money. So there is a lot to understand around psychological level on the gold market, and thanks to this, it's helping the trading of this area a lot easier. Also, the psychological level that is around this area is gonna help you identify where you have to enter the market or where you have to place your stop if you're going for a stop, because psychological level, such as a $50 round number, if I was to take the 50 here, you're looking at 2050. 2050 is another psychological level, not as big as 2000, but still has an impact there. How do you use this psychological level there? This level will have an impact on the market, because the market will tend sometimes to just push to reach that level in order to execute a sell or liquidating orders, because these levels are simply easier, and because they are easier, they are the one that usually you key in for order execution. Usually they are the one where most orders are placed. Usually they are the one there that algorithms tend to be using. And as such, level like this, when you come to trade around an area like this, when you get your interest, you could get shafted by this by not covering that psychological level. What do I mean by that? Imagine the trade is going there. Bam, you're going bang on your trade there. So you've got your area, price is going right into your area. Because this area now is slightly bigger than most people are used to, 80 pips. As soon as it breaks away from the price, say you do have a push there, a lot of you, by inexperience, will be thinking the zone has failed. And by doing that, we take a loss when it is unnecessary. Indeed, if you pay attention to this level there, it's providing you a strong backup for your zone. There's two ways to see it. You could see, okay, now I'm going to take this zone and I'm going to go for the first confluences, and if the first confluence doesn't work, I'll enter at the bottom of the confluences because I've got the psychological level to help me out. If you do this there, you got a higher chance of making your money back in a way, because there is a high chance that if you breach a set of confluences and you go toward the psychological level, the 2050, that the 2050 gets the reaction you wanted from your previous level. And as such, I like to have my zone of interest near this psychological level because they offer a stronger odds of success, and they offer me good reference for entry, for trade management, whether it's the stop or the targeting, and they are very useful, but they are often overlooked when it comes to trade gold. And as such, I see a lot of people that get the right area like this, but don't capitalize on it because they don't pay attention to the finer details such as this. So if you take a look at these and all of these areas, you see that you've got psychological level around there, and they will be helpful when it comes to the trade management. Now, trade management is really what I offer on the trading floor, helping you with the trading management, helping you with understanding how to improve your trading management, improve your trading plan, and reinforce the execution on the trading plan. This is what I offer on the floor, and this is how you can get better. So if you got interest on the trading floor, at the end of this video I'll give you more detail, but this is one of the reasons people come to me when they want to get the finer detail in their trading, just to get to the point where you've got the whole strategy covered, but then you have a management that allow you to execute on such a higher level that it will make a massive difference in your trading results. So based on that, these are the three next zones of interest. With that in mind, we have to understand that this is nice and good when it comes to tech, but these are against the current risk environment. Yes, we've seen a massive upside on the gold complex due to the risk of environment, which is led by instability in the economy worldwide, and this is caused usually by bank shit collapse, anything that is bank related, or war. And right now it is the war with Palestine, Israel, which is causing the market to be unsettled. Why does this have a massive impact? It's not so much about the conflict itself, it's about the repercussion the conflict could have if it was to widen up and get other markets involved. And as such, when this happens, the investors tend to dump like riskier investment, such as stock market, which will be affected by the war, commodities, and transfer the money across something that is much safer and has been bulletproof over the year, which is the precious metal. And this is why we've seen such a strong rally on the gold complex, over 2,000 pips since the conflict. However, what we can notice is that on our strong 2,000 area, we've had psychological level, we've had a strong pullback. And since we've had this strong pullback, yes, we've resumed the risk of environment. But if you match the risk of environment to what really happened, I think the worst of this conflict has happened in the past week. Yet, the smallest reaction happened on the market. And what that could have been telling you, what it's been telling me, is that we are easing off on the risk of environment. And as such, it's like the market has digested most of it. And as such, it is why I'm not expecting as much movement to the upside based on risk environment. It doesn't mean that it doesn't have, but based on risk environment, we kind of exhausted on the risk of environment. And this is another reason why I was happy to go with the S&P buy, which is doing good pips, 60 pips, as well as the short, because this alignment with the exhaustion of the risk off is now playing in my favor. But before that, this would have been short-lived. This zone would have been short-lived because you are clearly against the risk of environment. You still are, but it's exhausted enough for me to have an interest and a slightly longer term interest. So when it comes to picking the zone, there's also something else you need to consider, is the longevity of your trade. What's your trade like? Is it short-lived, medium term, long term? And this is not only defined by the tech. It can be defined by some of the technical aspects, but again, there's a lot more into the longevity of the trade. So again, if you're struggling with picking the trade or holding on to the right trade, or you never hold the right trade, or you hold on to the wrong trade, then maybe you are missing stuff as alignment and the fundamental understanding about the driving force behind the technical that made the trade work in the first place. And again, this is something I can bring you on my training floor. So when we look at it, that risk off now as is DOF. But there is a but. We are heading toward the last quarter. Now on the last quarter, there's two very important dates, and the first one is the interest rate. On Wednesday, we've got the FOMC interest rate decision, and as such, I think it's partially one of the reasons we have seen gold stalling in this area, and we've seen the S&P slightly bullish there. The market now has probably digested most of the risk off, but is also clearly waiting for a direction which is going to be given by FOMC. If you look at the FOMC Wednesday, the 5.5, so it will be the third time that we are unchanged. So it's probably mostly priced in. It's almost guaranteed that we get 5.5. So there will be no hike. Now, the last couple of times we had no hike, we had a strong US dollar. I think if you check the date with me, if you check the date, the 20th of September and the 26th, so that will be a day before this, because we are the 30th, but it looks like, yeah, it appears as the 29th. So the 19th of September, there you go, you got your reaction there, bullish US dollar, and 26th of July, 26, so we're looking at the 25th. Actually, the 25th was slightly bearish for the US dollar, but into our zone. So very difficult way of seeing how the market is going to be taking on the no hike. For me, the no hike the third time around, with everything that's going on, is pushing for a weaker dollar. So for me, it's pushing for upside toward one of these area. And if it was the case, based on where we are right now, to go to that first area here, I think we're too close. So if you're building momentum post FOMC decision with the switch, because everything is going to be on the statement, what is accompanying the no rate. If it was to be a no rate, and we see some bullishness on the gold, this zone is likely not strong enough to be momentum reversal. Remember, we are momentum reversal trader. We're basing this on the fact that somebody's gonna take profit. If you're bullish and you start making the momentum go to the upside, I don't think you've made a strong, big move enough to start considering taking profit. And as such, this will, if it has a reaction, it will be very limited for me. So, based on the fact that we are currently too close to it, I'd be happy to pass on just to go for the next one. However, now, if we are to see a strong reaction on the US dollar, which I doubt, but if you're looking at the tech, it is looking like the preferred option. So it's funny because my fundamental understanding makes me think that we're gonna see more upside, which is also working with the risk off. But the tech is telling me that if we were to see downside, it's working like a treat, and I'll show you why. If you check the latest fib, so 23 there, we've had a strong reaction on the 23 key level retest there. Trade we all gone for on the floor. It shows the first pullback there carried a lot of momentum, but that momentum wasn't followed by much more high. Indeed, when you get reaction from 23 and you make a new high, usually you get strong momentum, and that strong momentum hasn't breached the high by much. And now if you're looking at the field there, And if you're looking at the main level, my main level on gold, 38, 50, and 61. If you're looking at this level, 38, 50, 61, they all working perfect for one reason. They all are in double or triple confluences based on my strategy. And if you're looking at them, it means that all of these, they provide good areas for possible pullback. So we do have 38 with the key level that we've used there, break the retest of it with the EMA. By the time we get there, we could possibly have the next EMA as well in line. Currently the rejection, the 1900 area with this 50 and the 200 EMA, another possible level. And lastly, the 61 with a break retest of this infamous level because it smashed me on the way down, but I made it back on the web. The 85 level there on the 61. So all of these, as it is, all trade I would go for based on the tech. Based on the tech, all these levels are worthy of me going for them. The only difference I'm gonna have with this level is whether I get alignment on the market, which I can't time right now. But if I do get some sort of alignment with either silver, S&P, or other correlating asset, DXY, then it will reinforce not only the odds of success for them trade, but the longevity. So the only difference I will have in these potential trade is the management of it. And the management of it will be planned according to how the price action gets to them. How far are we from them? How fast we're going toward them? What sort of alignment we get from them will all tell me how much I can expect from them. But as it stands, they're all pretty perfect because they are near psychological level. They are small in zone, which is perfect because I don't mind the risk reward, but I can't deny the fact that the risk reward will look great on all of them because the zone to cover is very small, and as such, they look very good in terms of trade setups. And because they all look good and they're all quite far away, I tend to see the tech when it does that to show me that that's where it's going. So if you're asking me right now where gold is going, I have no clue, but I think personally, fundamentally, it will push up. Based on the tech, it's looking like it should go down. But either way, I don't care because this is the beauty of this strategy. You don't need to know where things are going. You are just prepared for both case scenario. And in this case, based on what FOMC is going to give me, I'm going to have a plan for either one of the direction. And that is a bit more insight on how I see gold and how I trade the gold market. Hope it was helpful. And in the next video, I'll try to talk more about alignment and probably we'll cover an in-depth S&P and see what we can get from it. Thanks guys for watching. Don't forget to like, comment and subscribe.